So let's go ahead and start our analysis. You can see that my last video at this point, we were talking about how just because Friday it closed at the 20-day moving average, and this is where the closure of that is at the 60-minute trend line. This was obviously a positive bias, but I've said that this doesn't necessarily mean that Monday, if there's bad news or something that often comes through the weekends, anything that is technically right that you see on Friday may get overwritten by bad news, just like what happened on the previous Monday. A huge gap down and immediate sell-off. Um, the Monday, obviously, it was a gap down and immediate selling, but it was quickly bought back up. Here you can see after the initial 15-minute candle, you already have support on the second 15 minutes. And of course, they battle it back to the 15-minute trend line, which it fails as expected. And here you establish a kind of a intermediate interim um, baseline, and of course went back up to test the 15 and stay at the 15. So like I said, the current data set or the current algorithms are basing technical around the 15-minute trend line and the 60-minute trend line. So at this going forward and in this current environment, you want to pay attention technically to these 60-minute trend lines, and of course the 15. So given the fact that it closed toward the high of the day, but still below the 60, that is of course a negative bias. And of course today a huge gap down on fear of the 10-year yields, the bonds being too high, and that gave a reason that is not necessarily the cause of why the futures were attacked. Often you see these futures attacked by day traders, future traders, momentum traders, and that lead to this condition. And in the pre-market, of course, the day traders, the hedge fund starts to hit on it, and of course you see a immediate sell-off. Um, and this is where you need to have patience. And low of day. So where is it on the daily? Close to the 100-day moving average. I don't necessarily think this is going to bounce, although it could very well bounce because this is a solid fundamental trend line. And if you were to use probably the simple moving average, it probably touch this, the tail probably touched this trend line, irregardless of whether it touched or not. It's close enough. But my suspicion is that tomorrow, I would suspect if it was a gap up, and the futures tend to suggest it's a gap up, I think any gap up will be sold into immediately to retest this trend line and also undershoot it. At some point, it will undershoot this low and go lower, and we'll see if the buyers can, um, I guess, maintain stability, reignite some interest to get the shorts to cover, and of course that will lead to the afternoon where essentially you will get the turnaround and the market returning back up for reversal Wednesday. So I think this Tuesday qualifies low of day, end of day low, closing, as is this right here. So I think that qualifies. And Wednesday hopefully will be the undershoot and then reversal Wednesday, as that is what we have seen in recent weeks, when the behavior of Wednesday recovering, and then of course Thursday and Friday leading to higher price stability and price averages. Looking at Amazon, this is what I was playing. Now I made a mistake on Amazon. Although on Thursday, I didn't make any mistake, even though it gapped down. Um, this moved higher was an opportunity loss. I did not collect any of this because of fear of this gap and sell off. I was, of course, afraid of additional selling. I took my first position on the breakout, and one of the best breakout is, of course, the breakout of a interim high. In this case, this interim level right here, where you can see the top of the first candle, this area and this area. This is where I took my first position on this candle going down, and of course I profited from this movement up, of which I closed because it was staying rather stable and it was at the 61.8. I was expecting a probability of testing the 5, undershooting the 5, and potentially I could get in another position to get higher. Of course, that didn't happen, and it closed close to high of day. Where did it end at? It ended right, well, it went up close to the 20-day moving average and the 50-day moving average, and of course it retracted a little bit. Um, so that led to today, which is of course Tuesday, huge gap down. And my first mistake is seeing that this 50% retracement. Now I was wary of what happened on last Monday. I just thought they would not repeat it for whatever reason. And the reason why I thought that may be the case was because on Monday, there was a lot of call buying across the board. You can see right here, there was across multiple price targets. You had significant volume that came in, and I'm not gonna pull up the screenshot, but um, essentially you had, you know, the significant um, prices or strike prices were in the 10 to 20,000 across the board. So most of them look like that. Let's see if the 33, yes, so most of them had volume that came in throughout the whole day, and it closed to the high of the day. So this was a brain seed. Even though I knew, you know, it did not carry over to the next day. I thought that after the initial selling was at this 50, I just thought there was a stability. So what did I do? I sold a straddle. Big mistake, obviously. Big mistake because if you looked at um, the VIX, so what I did was I sold the straddle when I saw that the volume was up here. Okay, so I suspected, okay, let's just sell the straddle and hope that it would stay at the 50% Fibonacci, and this would, of course, retrace, and I would make some gains as it battled around the 50% retracement. Obviously, that's not the case as it went all the way. The sell-off continued, and when you have accelerating sell-off, this is what happened. The VIX on the Amazon index continued to go up. And what this means is that the intrinsic value of Amazon. So let's just assume at this price point of 30, if Amazon was at 3,500, and then 2-3 hours later, the price point on the VIX is at 32 or 33. That same price at 3,500, the option of that strike would be worth uh, a lot higher. It could be 20% higher or whatever it is. Why is that? Because this is the determination of the intrinsic value or the theoretical value of a strike point. And the higher this is, the more valuable or expensive the option is. Despite the time of the time deterioration, this is not enough time deterioration This movement is overrides or is more of a factor than the time deterioration of the option. So at one point, I was down on Amazon as much as close to 3,000. Can you believe that? Close to 3,000 on selling the straddle. So that was quite amazing. Now I end up the day uh, uh, this rescue on the 38.2. So let's talk about that real quick. This 38.2 Fibonacci line up with the 200-day moving average. And if you were a very good technical analyst and you had programs, you would be able to see at this point, somewhere here, you would be able to see that the alignment of 38.2 and the 20-day moving average, that was sufficient to forward look that potentially the price movement would move down to that level, and of course it did, and it bounced right on it. So you can see 38.2 bounce right on it. I do not draw in these lines after the fact. These lines are always there, and when the 200-day moving averages came to meet that 38.2, the price movement, the price action went exactly to 38.2. So this is not a coincidence. This is all technical. Most of what the behaviors of these big high techs like Amazon and Apple and Shopify and Netflix and Nvidia, a lot of them, Google, a lot of them are based solely on technical, because the programs, the algorithms, the day traders, the momentum traders, the hedge funds, they are all looking at technical to determine what to do as far as either buying the shares or the options, or selling the shares, shorting the shares, buying the puts. So this is not a coincidence that it went straight to 38.2, bounced from there, and sitting at 33.21. I would suspect at this point this is still rather negative. Um, an intermediate or interim price range would be between the 50 and the 38.2. I'm thinking tomorrow the gap up would be anywhere to this level, maybe even have an initial head fake. All this head fake, this initial buying, this is all brain seed. Everything you see tomorrow on the upside potentially is a brain seed, meaning all it does is lead you into thinking that there is going to be a recovery. Oftentimes, if you look at the 5 minute, you will make a mistake of, let's see where the 5 minutes right here. Often, if you look at these 5 minutes, you will make a mistake, especially when it starts to go up. You will think that you're missing out, and at which point you buy in, and it will reverse and go all the way to the 38.2, potentially even undershooting, going below, and then reversing in the afternoon and maintaining some stability between this two key technical level. That would be for Wednesday, and hopefully on Thursday you will have the recovery of Thursday and Friday, similar to what happened last week. All of that can probably be deciphered or interpreted technically using the VIX. Now I knew what was going on with the VIX, and I stated that in the last video over the weekend, that this was all a colluded effort, last 45 minutes to attack the VIX. This is, of course, short sellers or whatever. I don't know what they did to attack the VIX, but all of this essentially was manipulated, artificial, not legitimate. So when that happened, there was a potential um, reignition of the VIX, because you can see in previous case like here where they attacked the VIX, it came back into full force before failing again. So I do think that is going to be the case again. Like this one, I think this one, and well, this one is the biggest one. But those two incidents, I think maybe potentially it will get tomorrow to the 25 before failing. So a good thing to do, it's you would never, obviously you would never know, but you're going to have to either risk, not the VIX, of course. This volume is higher, but it's not significantly high. So you're gonna have to look at the volume in comparison to, for example, what happened on Monday. So Monday had much more volume. So to get this powerful selling buying of the VIX, this powerful sell off in the global market, you're gonna have to have sufficient volume that are like up here for tomorrow. If the volume is not uh, is around this range or lower, any upturn potentially in the morning, you see this last final attempt to go above 28. It most likely will fail because that will lead into the afternoon for reversal Wednesday and it would go down. So I might potentially short the VIX, this VXX, and I haven't been doing that, but it really is gonna have to determine on what I see tomorrow and how I read it, whether the volume is going to be sufficient or not. So let's take a look at Google. Um, Google, of course, completely fell off the map. This is a strong stock in general for the high tech. And you can see at this point, I think Google may test the 20 week moving average because technically I think it looks weak. And so what used to be strong hands now potentially can be trapped for anyone who's trying to bottom fish. And there may be even a head fake where it go up and touch this 50 day moving average, right? So that's around up here somewhere. So it may go up and head fake, and this would lead buyers into thinking that Google is going to power back up, and it may power up because Google historically has been very powerful, but there's also this risk of failing at the 50-day moving average and going toward the 20-week moving average which would be above here somewhere. I don't think it would meet up with the 100-day moving average. My best guess would be it would be somewhere here or even here, right, somewhere close to the 100-day moving average, but not necessarily get to the 100-day moving average, and that's when it would power back up. Let's take a look at Shopify. uh, my prediction on this is this at this point does look like it's going to get to the 61.8, and that may even undershoot it a little bit. I don't think it will touch the 200 day moving average like this, only because this was a rapid sell off. Here you can see this rapid sell off to the 200. Now it could happen if the whole market tank. In the case where the whole market tank, yes, it will get to the 200, similar to what you see here. This is a fast rise followed by a fast fall. This is not a fast rise, this is a gradual fall, but that doesn't necessarily mean it cannot hit the 200. So I would be wary of a huge market correction because this 200 is quite inviting for for Shopify. So Tesla, of course, has been quite strong. Now I did miss out on this. This is just completely. I just took a break or went for lunch or whatever. Completely misses. This was a golden opportunity. This is a opportunity cost. Now I'm not gonna write it down as an opportunity cost because I didn't see it. But had I saw it, I definitely would tam to get in here, knowing that any penetration of the 15-minute for Tesla would get bought up, and of course it bought and um, we tested the VWAP, um, went above VWAP before ending lower. So technically, I think this is going to battle somewhat here. So I think the scenario for Tesla would be this interim battle in this data range before either going higher or going lower. Let's take a look at Apple, and then we'll end it with the SPY. So Apple, of course, touched right on the 100. So this is, of course, potentially bullish, but I'm not necessarily convinced that's bullish because it's maybe again a head fake. Now, the future dip is right now pointing to a higher opening because of Apple, I believe. This type of technical chart lead front runners, future runners to think that Apple will get some buying interest and a short covering rally can be achieved. Now, that's always a possibility, but I think any buying tomorrow can easily lead to selling, and that would mean it may be a very bad sell off for Apple toward this range, maybe the 140 before turning around for reversal Wednesday. So I don't necessarily believe that this is a support line, a resistance line where it a support line where it can bounce off of. Let's just take a look at Bookem real quick before looking at the SPY. So Bookem, I think this is a peak to peak. Like I said, this is peak to peak, and I think it will test the 60-minute moving average and probably undershoot the 60-minute because peak to peak tend to lead a lot lower, and at which point I may sell the straddle on Bookem. Bookem is a good straddle if it can maintain on this range. If it breaks out of that range is when it's a problem, but hopefully this is just a temporary. Now, this Bookem does show relative strength right now, so you have to be careful that it doesn't necessarily stay flat. So it doesn't stay flat for very long. So selling the straddle is of course risky. I want to look at iSearch real quick before maybe even look at Nvidia. So iSearch, of course, this is negative. I think it most likely will touch the 100-day moving average and go penetrate below the 20-week moving average. And let's take a look at Nvidia. Nvidia, of course, here it is. Again, this Nvidia is very strong, so you do think that at this point it is below the 50. So the next level is 200, which would meet up with the 20-week moving average. So everything seems to be negative as far as the top tech. So I think that does kind of lead into tomorrow being additional selling in the morning. After the gap up, any gap up will lead to additional selling, and then that would be the battle line to either continue to have a sell-off or a recovery. The SPY is of course above the 100-day moving average. So that does tend to mean, let's take a look at the 60. It did end a low of day or close to low of day. This is of course aftermarket, so it sort of bounce after market. So you're seeing a signature where I think tomorrow it will gap up around this level, uh, 435, but there's gonna be either uh, uh, an initial buying slash short covering or an immediate sell off. So I'm gonna be more patient tomorrow, definitely.